Welcome to the deep dive video update. This is a weekly video where I go through all the charts that I look at every week, and those that I didn't talk about or maybe only used once or twice, I take them and I put them into this video because we have to look deeper to see, are we still getting any insights from these charts? There are also some other charts that I only show in this particular video. They're more for informational purposes, so we can take that all together, combine it with the other analysis that we're doing to get a good picture of what's going on in the S&P 500. This is being prepared for Monday, April 28th. The first chart I just used in this video, it's a chart of the VIX, even though the VIX is invisible here. Over top of the VIX is a 50-period exponential moving average, and that gives us a range over a period of time. And when we're going up and we're in a bull market, we tend to go into a lower range with the VIX itself. And then when we're under pressure with the VIX and stocks are going down, then the VIX tends to go to a higher range. Well, we've been under pressure lately, and you can see over here on the right-hand side that we're starting to go up. We're still below that 20 level. Now, if we go above 20, if we see more declines from here, that's going to shift things quite a bit. That means the market's becoming more defensive. There's more hedging that's going on, and the market is probably going down at that point. Also, we look at a chart of the VIX, and we just want to measure what's the speed of the VIX overall. Is it going up fast? Is it going down fast? And with this particular chart, I use an RSI based on 9 periods, and we're just a little bit under the midpoint right now. So there hasn't really been a need to show this particular chart. Sorry about that. I had to adjust the size of my laser pointer. I couldn't see it there. You can see the RSI based on 9 periods. We're below the midpoint as the VIX has been coming down. And that's because stocks have been going up. Now we're still above 20 with the VIX, and that's a concern. We are more positive when we drop below 20, but as we've been really going up, that's why we're seeing this previous chart actually starting to possibly go up into a higher range. It's not there yet, but we want to keep an eye on that. Okay, then we look at the VIX and do a correlation with the S&P 500. Right now, we're getting a very low reading here, so we're not getting a lot of additional insight from this particular chart. We really pay attention to this if this correlation actually comes up to a very high reading, but we're not getting that right now. Also, we look at the VIX, and then there's a thing called the VVIX, the volatility of the VIX. And when this is going up the way it is, that means the VIX is actually outperforming the volatility of the VIX, meaning that we're going down, and that's really what we've been doing with the S&P, and we're still continuing to go down. Even though we bounced and had a pretty good week, it hasn't really changed the overall climate of the VIX, at least to this point. And we look at the skew index, which is a variation of the VIX. It's calculated in a little bit different way. And we really only pay attention to this chart when we're up in the red area. Well, we're down below the red area, so there's been no need to show this chart. Then this is the Landry volatility measure just on the S&P 500 itself. And we were going along, not really seeing any real increase or decrease necessarily in volatility. And then as we started coming down, you can see the volatility really picked up. So this is kind of like a VIX just for the S&P 500. Even though the VIX is calculated on the S&P 500, this is calculated in a little bit different way. But we see a spike up here, and we've just been trailing off and going up just a little bit. And so I don't think that we're getting any real insight from this chart right now. Also, we look at the volatility of stocks as measured by the VIX, and then the volatility of bonds as measured by the MOVE index. And I follow mainly the red line here, and both have been quite volatile. But bonds are outperforming stocks year to date in 2025, and stocks have been going down as bonds have been going up. And that's why we're tending to see this red line going up, even though it has been dropping down lately. Now, if we turn back more positive and stocks are able to break out and actually turn more positive, we would probably see this ratio come down. And if that lasts for a while, we would then start to see this red line come down. But as long as we're still going up, the market is still more defensive overall. Large cap growth. This is a huge part of what drives the indexes higher or lower. Still negative here. We're still below all the moving averages. There's a 50-period moving average, which is now crossed below the 200. That's a death cross. That means the longer term trend is negative, but we have been bouncing back up. But even with the bounce that we've seen so far, we haven't even come back up to the moving averages yet. Now, if we do, these lines often act as overhead resistance. When we're above them and come down, they quite often act as support. So now we'll be watching. If we keep going up, will this provide some problem for the large cap growth anyway to keep going higher itself? Then I look at a ratio between the Russell 1000, which are large caps, and the Russell 2000, which are small caps. Small caps are still really struggling, and large caps are doing a little bit better. But even when we were going down, we're seeing this ratio going up, meaning that large caps have been holding up better than small caps. And just for informational purposes, we go and say, all right, where are we from the October 2022 low? Well, with this nice little bounce that we're getting right now, we're up 58.11% from that low. And then we set another low in October 2023, and we're up 34.64% from that low as well. Then stockcharts.com has these things called technical alerts. These are predefined and they're used around indexes and sectors and just gives us an eye view of what's happening at the macro or bigger picture level. You can set up your own individual alerts, but these are just ones that have already been predefined. And this is really hard to read because there's so many things on here. What we look for in this chart, this goes through the whole week. And if we're having a down day, we see a lot of red. Well, last Monday, it was a pretty negative day. We went all the way down to 5,100. Well, then we started to stabilize and see some improvement. And so we're seeing a lot of green here as we've been coming back up. And these are triggering these technical alerts that are showing that things are in fact improving. There's a few little red areas along the way, but we started off negative and ended quite a bit more positive. Then I take 6 different indexes and rank them on a score of 0 to 100. The higher the score, the better looking that particular index. And coming in first place, which had been really lagging behind, are the QQQs. This is the NASDAQ 100. This is growth. And growth had a pretty good week this past week. It still has a long ways to go to repair the damage that has been done, but it is coming up. Where a week ago, this particular ETF was quite a bit further down in the ranking. But with the move up here, it's coming in at 42.2. Now, that's still a really bad score. We want to be up in the high 80s, low 90s to show real strength. But compared to the other indexes, right now, this one is looking the best. In second place is the S&P 500 as measured by the SPY. That's the ETF for the S&P 500. It's coming up a little bit here. Still a really bad score at 33.8, but based on the other indexes, it's in second place. Then we have the NASDAQ composite itself, and the accompanying ETF is the 1Q right here. It's showing some improvement. Still not great at 30.3, but it is coming up a little bit. And then we have the Dow, which for quite a while, the Dow was holding up the best. Well, we had United Healthcare come out with earnings and other companies coming out with earnings. And there's only 30 stocks that make up the Dow. So if one, maybe two members of the Dow are having a good or a bad day, that can impact the whole index itself. And this is considered to be the best of the best stocks and a lot of value in these stocks, which tends to be more defensive. Now, there are growth stocks that make up the Dow, like Nvidia and Microsoft. But as we've been seeing a bit of a bounce, and we're still trying to figure out, are we just coming back up into the high end of the range that we've been in, and we're going to top out and then start to go back down? Or are we seeing a genuine improvement that's going to turn everything back more positive? That's what we're evaluating on a day-by-day basis. Well, right now, the Dow has dropped from first place, where it was for quite a while, down to, I think this is third or fourth place here. This is at 19.6. So it's really showing some weakness. Then the mid caps, which have really been struggling, but at least they're in double digits. They're coming in at 12.1. And then single digits, well, unless you count the decimal here, this is the IWM. This is the Russell 2000 small cap ETF. And you can see they've just been flatlining here below 10 for quite a while. There's just not a lot of strength in small caps right now. There was a lot of hope back in December and in January. You get the January effect and the hope that was interest rates going down, that would be more friendly for small caps. Well, it just hasn't really worked out. And we thought that a year ago and 2 years ago, and it just hasn't really developed to this point. All right, then I have a short-term rainbow, and these are just a series of moving averages from 10 periods up to 50 periods. And I changed the color so it looks kind of interesting here, like a rainbow. And even though we're coming back up a bit into the rainbow, all of the lines are still going down. Now, in the short term, I measure the short term by the 20 period moving average, and we're back above that. So the short term is actually turned back to positive, but the intermediate term, the long term, they're still negative. And it's not like we're seeing a lot of strength right now. We're seeing an improvement, but we haven't really seen a switch back over to looking more positive. So in the meantime, these lines still continue to go down. Then another intermediate term rainbow going from 50 periods up to 100 periods with a simple moving average. We are below it. And even though we've been bouncing back up, we haven't even come back up to any of these lines yet. So they still continue to fall. This also confirms that the intermediate term trend is negative. And then we pull this out. We look at a 50 period moving average. And I haven't been showing this because we're so far away from it. If we do start to go up, we'll be watching to see if there's any overhead resistance at either the simple or exponential moving average here. But as long as we're far away from it, it's like, okay, tell us something we don't know. Also, the same thing with the 100 period moving average. Still have a ways to go just to get back up to that level. Bollinger Bands, we did look at these earlier on. When we were really coming down in the earlier part of April, we actually closed down below the lower Bollinger Band. Well, since that time, we worked that off and we had been negative since we're below the midpoint. Well, we are seeing an improvement. This dashed line here is the midpoint of the Bollinger Band. And so this is turning more positive. So this is confirming some of the improvements that we're seeing in the market currently. And this is the Landry light. And even though we've been bouncing back up, you can see here, red. This means that we are still in a downtrend according to this chart and these indicators. Proper order, another way of measuring this based on color, where the background here is red. That means that we're still in a downtrend here. And for the as long as this goes on, these lines just continue to build on each other. It doesn't mean a stronger or weaker trend. It just means a longer trend. Then I use the Carner's RSI, very similar to a regular RSI and other momentum oscillators, where we look for extreme positive or negative readings. And on a day in and day out basis, this thing just gyrates all over the place. I only start showing this in the daily videos if we go above the black line to the upside or below the black line to the downside. We're not there yet. So there's been no need to show this chart. And this is more for information. This measures as of Friday's close, just how we have been up about over 25.58% from the October 2023 low. Now, I have to eyeball this, so this may not be exact right here. But how I also use these measurements is that when we hit a top and then start coming down, we measure that on a percentage basis because as long as we're under a 10% decline, that's considered a pullback or just a short-term decline. If we go into over 10%, now that's called a correction. And if we fall over 20%, that's considered a bear market at that point. Well, we've been coming down here and on an intraday basis, when we had that really big down day and we bounced off some major long-term support, we were down over 21%. Now, but that's on an intraday basis. The definition that the market uses is the February 19th all-time high to whatever the close is. They base it on closing prices. If we're down over 20% at that point, that's considered to be a bear market. So on an intraday basis, we did go into a bear market, but have since come out of that. On a closing basis, we didn't get into a bear market. We were a little bit less than that 20% level. And we've been coming up right now. I haven't been showing this chart because we're kind of in between all of this as the market is trying to rebound. Then this shows how far away are we either above or below the 200-day simple moving average. Well, we're below it, so it's red, but we are improving. Right now, we're 3.8% below the 200-day moving average. And anchored moving averages, I use these a lot, but the market's been so crazy lately. We've just been blowing through these different support and resistance levels, and we're just slicing through them. Sometimes we come down, hit one of these levels and bounce, but we just come down, blow right through it. Then when we bounce, we blow right through it again to the upside. So I don't see where we're getting a lot of insight from these charts right now. Then we look at the S&P 500 and compare it with the S&P 100. This chart is just showing, no, we're not really seeing any divergences here. They both were going down together. They're both going back up now. And the S&P 100 is still on a longer term basis outperforming the S&P 500, even though the large caps, which make up the S&P 100, have been underperforming so far in 2025. Then a long-term rainbow going from 50 periods up to 250 periods with simple moving averages. Still have a ways to go just to get back up to the rainbow. And the longer we stay down here, the more these lines will continue to come down. Then this is an oscillator that I mention in every video, but I don't show the chart. I only show it in this video because we only get maybe one signal a year. And that was the last signal to the upside was in late 2023. And then here in 2025, we did get a negative signal. This is a special K, just like the serial, and we dropped below the red line. Now we're trying to turn up a little bit here, and the red line is still going up. That's positive. We could still recover from this, but in a very generic sense, when we go below the red line, that's negative. And that's what I've been calling this chart ever since we crossed back in March. Then we look at a weekly chart of the S&P, that's US, and then the German DAX, which is the biggest index in the EU, and just do a correlation. Well, right now they're neutral. The earlier part of 2025, German stocks were going up as US stocks were going down. Then they were all going up and down together there for a while. Well, as this is gyrating around, the correlation is pretty much not telling us anything. Then we look at different support and resistance level. This is an Ichimoku cloud, which are really just a series of moving averages that are then shifted forward. And sometimes they provide support or resistance. And there's some other studies that we can look at to see what is the basic trend. We're far away from the cloud, so there's been no need to show it for that reason. And if we continue to go up, we might hit overhead resistance at one of these red cloud areas here. Now we are seeing an improvement though. This green line, this is short term, and we've been bouncing up lately, so that's more positive. The blue line, which is more intermediate term, is starting to cross above the red line, which is also turning this back more positive. So when you measure this on a trending basis, we are showing an improvement, but we're still far away from the cloud itself. So I haven't seen a need to show this because we get a lot of these improvements that we're seeing on this chart. We also get them from other charts. And a broad market measure, this is the VIXN, which is the volatility of the NASDAQ 100, or the VIX is the volatility of the S&P 500. And it's been coming down as the NASDAQ 100 has been doing better, but we're still not dropping below this moving average here on a closing basis. It's still coming in at a high reading, meaning that fear is elevated. And here are the QQQs, which we're in a downtrend now. We see the 50-period moving average has crossed below the 200-period moving average. That's a death cross. Then I also have a 20-period moving average plotted on here. That's the shorter term one. And we've actually been able to get back above the 20-period moving average with the Qs. So the short-term trend here is positive, but the long-term trend is still negative. We need to see this continue to go up to show more signs of an improvement. And this is a weekly chart of the Qs, and this is actually looking a little bit better. This chart comes in and out of the videos just kind of as I'm seeing something, but this, we showed the move down that we had, and then we set the low, and then at least on when we're going up for the week, we're setting higher highs and higher lows. Now there's some exceptions to that here. We had an inside week in the previous week, but that was There was only 4 trading days. We were closed for Good Friday. But if you look at this, this is looking kind of constructive from a longer term perspective. Can this continue? Can we, in the upcoming week, can we set another higher high and possibly a higher low? That would help show here that the QQQ's chart is improving. Then we look at the S&P on top, which is growth and value. And then we look at the Qs, which is growth, and the diamonds, which are considered to be value. That's the Dow. We do a ratio, and then we see that the correlation between the two is pretty strong. And this is pretty much what we expect for most of the time because the Dow is value, the Qs are growth, where the S&P is growth and value, but it's a weighted index, so growth has much more of an impact on the S&P itself. But looking down here, we're not really seeing anything out of the ordinary with this chart. We keep an eye on the Dow and the transports. The transports, that's the red line. They just cannot seem to do very well. And they're really underperforming the Dow here. And now the bank ETF, we want to keep an eye on the financials, which when we look at the financial sector is doing okay. Not great, but okay. It's trying to get back above its 50-day moving average. Well, inside of the financial sector are the banks because we had some problems a couple years ago with banks falling apart. And so we want to watch this ETF. Are there any problems that go beyond just normal market forces? Right now, it looks like it's just the market's going down, so the bank ETF goes down too. Even though we are in a downtrend, we are starting to come back up here. And then we look at a ratio between regional banks, smaller banks, and the financial sector. And it's in a downtrend, but it has been coming back up. And that would be more positive if we see the smaller banks starting to do better when compared to the financial sector itself. Rate of change charts, I just use these for long-term observational purposes. We are coming back up here with our 250 period rate of change. This looks at Friday's close and goes back 250 periods, which is well over a year ago. And just to see what is the change been. And if it's higher, then we go up. If it's lower, then this chart goes down. And we look at another chart here. We came all the way down to this midpoint and we're starting to bounce back up. So longer term, we're seeing some improvement. And we keep an eye on bonds. And I do use these charts in the what to watch video update because I'm keeping an eye on this. We have to know the context of what's going on here. There's a lot of concern about inflation and interest rates. Is it justified? Now, it might be justified, but what's the market think? And when we see this coming down the way it is, even though it's blue because we're in an overall uptrend, when the market is concerned about interest rates and inflation, this ratio goes up. It's still continuing to go down. In fact, we might see a death cross with this ratio pretty soon. Now, this is shorter term. This looks at 1 to 3 month T-bills, which you could pretty much call cash because you get like minuscule interest rates on that. And we compare it with shorter term bonds, 3 to 7 years. So if the market was concerned about inflation on a short-term basis, this would not be going down. It would be going up. So that's actually showing that the market is not concerned about inflation. And we take it a little further out and we use a different, instead of using cash, we look at a different instrument called TIPS, which are Treasury Inflation Protected Securities. These adjust for inflation and interest rates. And these tend to outperform when the market's worried about inflation and interest rates. Well, right now it's bouncing back up a little bit lately, but we could be seeing a death cross here with this ratio, meaning that the market's not really concerned about inflation and interest rates. There was a little pop up here. We'll see if this continues and starts to go up, but if it stays underneath the moving averages and kind of chops along sideways, that would mean that there's not a lot of fear in the market right now, at least according to the bond market. Then we look at further out bonds. We use TIPS again, and we look at 7 to 10 year bonds. And the overall context is that we are going in an uptrend here, but we've really been pulling back, but we're not seeing this skyrocketing up. So inflation worries or expectations are actually coming down a little bit, and they're pretty much under control right now. And this is what we've been seeing over the last few weeks. Then we look at the long-term bond, which is a TLT, and then we look at the S&P 500, which is in red. And we can see on a short-term basis, they both have been going up. So the price of the 30-year bond and the price of the S&P, that they've been going up together. And so the longer-term correlation is improving, and the shorter-term correlation based on 10 periods is also getting stronger. We do that same basic thing with the QQQs, which are growth, with the TLT. Instead of being blue, it's red here. And we see that it's pretty much neutral with the long-term correlation, but it is starting to get stronger. In a more positive environment, you can see bond prices going up, which means interest rates are going down, and stock prices going up at the same time. They're correlated with each other. Well, that could be changing, but we need to see more here to see if the correlation is actually getting stronger. And we look at the US 10-year yield on top. We subtract the German 10-year yield, and US rates are higher, so we get an answer that's above zero here. And then we plot that with the US dollar index, and as strange as this sounds, there's a continual high correlation between the top chart and the US dollar index. And so this is really telling us, even though the dollar's been under a lot of weakness, interest rates over the past week or so have been coming down. And this is not showing that anything is really out of line. When we're up in this blue area, that means that the market is acting with a little bit more efficiency according to interest rates and currencies. We keep an eye on the 2-year Treasury yield, which has been coming down for the most part. It did go up a little bit in Friday's session, but sometimes when this spikes and starts to come down, that can give support to stocks. Not so much lately. We're trying to see, okay, is the overall climate changing? When these short-term rates come down, does that really give a boost to stocks? And it hasn't, I mean, it hasn't really been negative, but it hasn't been all that positive either lately. And then we just want to keep an eye on different yield curves. This is the 10 to the 2-year yield curve, which is normal. We're above this blue line. That means the 10-year yield is higher than the 2-year yield, which is what you would think it would be all the time. Well, it is. And this is a steepening of the yield curve. What we're watching for is that it spent a lot of time being inverted, meaning the 10-year yield was below the 2-year yield. And then we went back to being regular again. And this is where we see the countdown, and we don't have an actual number of days. It can be just a period of time. But now we're more on recession watch to see if we're going to actually go into a recession. And as this keeps going up, that might mean that a recession may come about. But then we use a lot of different charts, and I do updates on the website with the recession outlook. And so far, we don't really have anything other than vocal concerns or people just expressing opinions, thinking that we're going to go into a recession. We're not seeing a lot of factual data yet that could be suggesting that. Then another yield curve that we follow is the 10 to the 3 month. And this is back to being inverted after Friday's session. So we kind of begin the countdown again. We had been inverted for quite a while. We went back to being normal. Now we're kind of just dropping in and out of inverted, uninverted, inverted, uninverted. Well, we're down a little bit inverted again. Not as many people look at this particular yield curve, but I like to keep an eye on both of them because they're not necessarily confirming each other right now. We're seeing the previous yield curve going up, even though it did pull back, and we're seeing this yield curve actually coming down and going inverted again. And just to compare apples to oranges, we look at European stocks and compare them with American bonds, where European stocks have been outperforming American bonds lately. We came way down below the rainbow as everything in the world was getting smacked. Well, Germany is starting to outperform the 3 to 7 year bond based on price. Then I have a number of things called possible positive scenarios, and these come and go, especially when we're going down. They come and go in and out of the daily videos. Well, this is an oscillator. These are the percent of stocks above their 200-day simple moving average. Now I have another chart that shows the same thing, but I have it set up a little bit differently, and we try to get a little different perspective from the same basic indicator. And some people don't think this is all that important. I do. I see some real value in this. Well, when you look at the S&P and the stocks that are above their 200-day simple moving average, we're still below 50. We were getting a low reading, but we didn't get all the way down here to this red line. That would mean that we're oversold, and we're starting to bounce back up. Now, we're still negative because we're below 50, but we are showing signs of improvement. And we use that same basic concept, and instead of the 200 period moving average, we'll look at the 50 period moving average with the S&P, and we are improving after we did get extreme negative, and that's when we had that really big down move, and this actually can triggered an extreme negative reading, and we've been for the most part bouncing back up here. So that's showing an improvement, but we're still below 50 overall. And just to get a little broader market perspective, we look at the mid caps, which also gave an extreme negative reading, showing some improvement, but still below 50. And we look at the small caps, which also gave an extreme negative reading, still below 50 though, and showing slight signs of improving there. So thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.